Well, up next, we have Mr. Jack Wiehl here from Exxablock with us, and Andrew is going to continue on with him. And we also have Sunwoo Park with us from Exxablock as well. Thank you for joining us, gentlemen.
Thanks so much.
Thank you.
Awesome. Well, Anthony, as usual, I will leave it to you. Thank you so much, guys.
Awesome. Jack, Sunwoo, great to have you on. Thank you for joining us today. How are you guys?
I'm doing great. How are you?
Great.
Doing absolutely incredible. Thank you. Thank you very much for taking the time. Well, listen, we have an exciting, packed full information today to learn more about. You both of you are going to take us through a deep dive into the analytics around the crypto derivatives data and what it tells us about the spot markets. So we are very excited to learn about this. I know you guys have some insights to share with us that I think as traders, we're always seeking to find new and innovative ways to be able to get information that people maybe not be looking at, that give us some insights to make some decisions. So we're excited to hear how you guys are actually able to see ahead of the turn of the market earlier this year in April by using this data.
Awesome. Yeah, we're looking forward to it. Let me share my screen. We'll start our little presentation. Ooh, hold on.
Awesome. Yeah, so you guys are going to give a presentation, and while you're doing that, Jack, why don't you, if you don't mind, just giving, when you do kick this off with the presentation, just give a little bit of background about yourselves and, who Exxablock is and what you guys do.
Can you see our screen right now? The presentation?
Yes, we can. Yep, we're good.
Is it the,
yep, it's it.
Perfect.
It's the first page. Yep, there you go.
Okay, awesome. So we're Dr. Sunwoo Park, and I'm Jack Wiehl from Exxablock. So the presentation we're going to give today is going to be kind of interpreting the tea leaves and how we can compare the spot markets and the derivatives markets to learn a little bit more about maybe where Bitcoin, for this example, it's going to be Bitcoin is going. And we're going to do that via case study from the all-time highs to where the first day kind of came in, where we could see that there's a big risk that we've just seen all-time highs with a little pullback. And then eventually 2 weeks out, we saw a massive, almost 40% dump in the market. So we're so excited to be presenting for you guys today. And we'll kick it off. So this is kind of the area of the case study that we're going to be looking at today. At April 14th, 2021, we had this all-time high of 64 to 65K, where we, depending on which exchange you're at, and we're going to just kind of go forward 5 days at a time and just see where the options markets are at, and that's kind of going to be the full, and where we could really see about here, about 15 days before this drop, we could see that there was a high risk in the market. So all of this data is collected via our Exxablock report, or into our Exxablock reports. We have analytics, indices, our executions, and then our blockchain data. And it's really aggregated spot market, options market, futures market, swaps market, and blockchain data that we collect 24/7 and then aggregate and put into one daily report, which we send to our customers' emails. Today, we've got Dr. Sunwoo Park, who's going to be answering some questions. Sunwoo's been a real expert in quantitative regulation and technologies, and has a lot of experience in high and medium frequency trading and market surveillance, while he worked in the past at Citigroup and the Securities Exchange Commission. And then myself, I've worked in venture capital, and my trading focus has been in market making in spot cryptocurrency, and then in some futures markets. So let's get started. So a little kind of want to brief you guys a little bit on what a spot asset is and what a derivative asset is. Just a little refresher. So for a spot asset, we're going to be really talking about the purchase of a stock, or in this example, it's going to be in crypto. And an example of this is going to be, I give you cash, you give me a share of stock that's settled T+2 for the traditional markets. And for the crypto assets, it can be fairly immediate. And an example of that is, hey, I want to buy 0.50 Bitcoin. Here's the cash. It's pretty immediate. Or, like our last example was USDC for Bitcoin. Or I want to sell 1.23 Ether, and it's fairly immediate. So for those who don't know what a derivative asset is, these are things like option contracts, futures contracts, warrants, and perpetual swaps. And they're called derivatives because it's a financial instrument where the price is determined or derived on the value of another asset. And it's usually, could be a spot asset. And it's usually based on buying or selling at a future date and time. And we'll talk a little bit about, so why would you buy a derivative if I could just buy the outright asset? And there's three main reasons that we kind of think about it. There's speculation, which is, hey, I want to take a directional trade. I want to go long. I want to go short. This is a little bit of a higher risk trade, but it has the potential to earn high profits and incur high losses. We have hedging, which is where you pair the derivative maybe with a spot or with another derivative, and it's a reduction of risk. And they're a really useful tool and kind of can be used as an insurance product. And we believe as a trader with derivatives, we get the benefit of leverage, which can aid us and can hurt us. We can buy more with a lot less money, but we can also lose a lot more money. So it's the double-edged sword of leverage, and understanding how to use this tool and how it can hurt you is very beneficial. So
Jack, real quick.
Yeah.
If you don't mind me just jumping in real quick,
Yeah,
not to interrupt your flow, but I think just what you just said was basically that from a tool set perspective, if I'm trying to seek alpha, right, and I want to be able to be a little more speculative, I can use these to maybe trade around my position that I have on a spot basis. Or if I'm looking at it from a just risk management perspective, I can use this from a hedging perspective and a way to be able to actually manage my risk outside of the actual spot trade itself.
Yes. Yeah. Or you can pair it with the spot trade to reduce a directional risk, or, maybe if you've got a long position in Bitcoin, you can pair it with a put, and it, makes it less directionally risky if there's a massive drop in the market. Just one example. There's, that's like a whole presentation in itself, is all the ways you compare calls and puts and futures and spots. But learning a little bit about it is very beneficial, kind of as we go into this next section where we're going to talk about market participants. And how we fit into the macro scale of who is buying and selling in the market. So with our market participants, it's how we fit into the picture, how they fit into the picture. And at Exxablock, we think we put this chart is right on our second page of our report, and it's just a great educational tool. And it gives us an idea of who's on the opposite side of our trades. We never are really going to know literally who is on the opposite side, but who could be on the opposite side. So this is the CFTC commitment of traders, and they believe it's a great tool for the public to understand market dynamics. And I recommend everyone on this to go afterwards and read about every single one of these, the dealers, intermediaries, asset managers, leverage funds, and how they, like, what maybe how they use these tools. So we really the CFTC breaks these into buy side and to sell side participants, people who buy an asset or, generally buy an asset, and people who sell an asset. So the dealers and the intermediaries right at the top here, they are design and sell various financial assets to clients. And, they're the way that they tend to work is they tend to earn commissions or capture a bid-ask spread, but their job is to really accommodate clients. And then we'll go to the other four over here, which is who the sell clients are selling to, the buy side clients. And these are people who really use the market to invest or hedge or speculate, trade. But they use the tools that the dealers and intermediaries sell. So this kind of helps us. We want to know how these people are making money. That's the real, why I like looking so deep into every one of these participants, is because they all want to make money, but they're all doing it in a little bit of a different way, and they all have certain risks and ways they manage that risk. And a lot of them do use options, paired with spot, or just use options to reduce their risk and to make sure that they're going to make money over and over and over again.
So these are right here specifically futures plus options positions, right?
Yes, but I think the reason why we put it there, it is futures plus options positions, but a lot of these people pair these positions with spot positions, or they use these positions to reduce risk in their spot positions.
So the dealers and intermediaries would be such as like the exchange, or maybe a liquidity provider,
brokerage. Yeah, exactly.
Yep.
So let's continue. We're going to start the case study. We're going to start at options, or April 25th. We're going to start looking. This is the spot market of Bitcoin USD. We're going to use Coinbase for this example, just to, for simplicity's sake.
So the market data is Coinbase.
Yeah, for the spot market. It was just so we could kind of go back in time and shift, and just for this example. So we had this huge excitement. Bitcoin's hitting all-time highs up here at about 65K. It's never going down. There's this huge excitement.
Yeah.
And then we have right this pullback right after. It drops from 65K to 49K. It's not really that out of the ordinary. It happens every time there's the move up, there will be a move down. There's a new lower low from this area over here to down here, and a little bit of an increasing sell volume in the spot markets. So we'll move on to the next page. We're going to compare the spot markets to the options markets, and these are right from our daily report, where we're going to look first on this left side. We see the April 30th contract with the most open interest, which is buy calls and puts that are bought or sold. They're open.
Hey, Jack, can you take 1 minute and just kind of explain a call and a put real quick, and just so they can
so
means, like what side of the trade that these people are on, the blue?
Yes, a call is I'm betting that it's going to go long or higher at a certain price level at a certain date. And then a put is I'm betting it's going to go below that at a certain price at a certain date. So for example, on this bottom row down here, we have in the left, we have all the expiration dates for these option contracts. The day when it's got to be above or below based on your bet. And then the open interest over here is open contracts that people have opened up and are live in the market. So
April 30th looks pretty even, right? Like as far as
So this down here, the call and put ratio, we have they tend to be fairly even, and this is kind of how everybody wants to be market neutral. A lot of people think of directional trades, but as a brokerage or a dealer, we want to think of as market neutrality, because it decreases directional risk. So generally, when you look at this chart, it will be close to a 50-50 split. Although when you do see these imbalances in a call or a put side, you can maybe infer that there is a worry in the market, or people see, oh my God, but at this time, we've been going up, there's excitement. So we're favoring a little bit more on the call side. The puts are, a little bit less. And, then we'll kind of look over. So this this chart over on the right is aggregated. It's aggregated calls and puts from, we have Bitcom, CME. Let me see, I've got it on my other page. In our report, they're aggregated from Bitcom, CME, Deribit, LedgerX, OKX into one report. So we have about 5 options contracts that are all aggregated into one. And then you can see the strike prices that are most active. We obviously see this $80,000, visually it's very, okay, so there's a lot of people placing calls at 80,000 for expiration at April 30th.
So people, so in that scenario, people are pretty optimistic, looking at that price continuing to go up, right? That's
exactly. So, and it's remember, it's the April 25th, and we're right. April 30th. That's 5 days. Right. If we go back, where were we at? We were at 49K. Exactly. And people are thinking in 5 days that the market's going to go from 49 to 80 plus, 80K. Yep. And the top 3 calls are 80K, 60K, and 72, which kind of builds this little area over here. And then the top 3 puts are at 52, 50, and 40K, which are over here, which are people thinking it's going to go lower in the next 5 days. Yep. So we're going to move forward a little bit in time to April 30th. So April 30th is important because it's the expiration day. Traders are shifting their trades into the next month. People may be closing. If you're in the money, you're very happy, and you're probably taking your profit and walking away and thinking of your next trade. We see this little, we had a big drop. Let me go back. Sorry. We've got this big drop. We've got a little bit of a pullback from 49 back up to 58K, which is, that's a pretty big move if you've got a lot of volume. And we want to remember there's that 80K call that we were looking at and the 52K put. Those were the highest open interest calls and puts in the market. And they're kind of building a little bit of a buffer zone on either end.
Real quick.
What was that?
Sorry to interrupt you.
No,
yeah. So real quick, I think just to give the audience a little bit more insight. So people on the expiration date, what are their options? What can, no pun intended, what are their options?
What are their options?
What can they do, right? What can they do with the derivatives that they're holding? In this scenario, the options that they're holding.
So they can roll their contracts into the next month or a deferred month. So they can go, in this example, January, February, March, April. From April into the May, they might roll it the same position. If they want to keep it open, they might roll it from this contract into the next one and just keep an open position. They could leave it open and be out of the money or in the money, collect their profits, or just accept their losses. Or they can close the position and kind of get out of it early and just move on to the next one.
Great.
So, we've got this little move up. Traders tend to be rolling or doing the things we just talked about, where they're accepting or they're just, moving on to the next one. So I built this we've got this 80K, we've got this 50K that are kind of the highest open interest calls and puts in the markets. And then we've got the blue line as the spot price. And you can see it kind of ends up sitting right in the middle. We have very few calls to the right that are in the money and very few puts to the left over here that are in the money. So it's a good day to be a selling calls and puts, to be a seller of options. You're collecting premium. It's good for you,
So it's kind of like so it can be seen maybe as like a earning strategy, effectively.
Yeah. That would be an earning strategy. There's 2 sides of every coin. You could be taking directionals, and this one, the earning strategy where people are selling options, would be very happy. It sat in the middle, and there's very few that are, that are in the money where they have to pony up to say the least.
Yep.
So what happens next? It's the end of the month. We saw that big high. We saw the low. We kind of came back right in the middle, and we move over to the next one where April 30th. Where are the options moving? Where are traders shifting their next position? We see here's that April 30th, the first bar over here in the left side of the screen. And we see it shifting not into the May contract, which is the next contract, but into the June contract, sorry, which is interesting. Why is that? We would probably say it's the end of the quarter. So, as a business, there's, you want to maybe collect profits or protect from losses for the end of the quarter when you do your books, and just an example. But the highest open interest, we actually we focus more on the June contract than we actually did the May contract right here, because most people are taking positions in that market, and they're showing their cards a little bit, showing their hand on the book, and we'll look at the strike prices in these June contracts, and remember we had that 80K. Which is now fairly non-existent. It's actually shifted to the 100K call was the highest one, which is, and we've gone from 80. Now everyone's thinking we're going far out. I want 100K by the end of June. And let's see what else we have. But
so people, sorry, Jack, real quick. So people are thinking, I'm just trying to understand, what are actually people, because, effectively the market's a psychology, right?
Yeah.
That's all it is. So and how we, as traders, what we do is we try to find out what is everybody thinking? Where is everybody thinking this is going to go? So what is that kind of, I guess maybe dive a little bit more in. Like, you're seeing the May contract have a little bit less volume. The June seems like everybody's going into the June contract. What from your perspective, from your opinion, what is it?
My perspective is, so the end of June, it's the end of the quarter. I want to, maybe I'm taking, if I'm a miner, if I'm a fund, if I'm, something like that, I want to be maybe protecting losses if I'm, or just locking in a price in that I can write on those books, and I know I'm going to get that price. Even if the market drops, I know I'm going to have that price, which, as an insurance is pretty good for, accounting purposes. As I'm trying to think, as a trader, I see a little bit of, on this call side, I see not a real number where people are saying, I think it's going to be, we know that this 100K is the highest open interest. So we know that there are literally more people saying, I think by the end of June, it's going to be above 100K. But there's nothing really sticking out up here. Now we go down to the put side and we see this 40K put, that's, and immediately it's the first of the month, and we're all like, my team, we were talking with a few traders that we talked to, and I presented this to them, and everyone goes, oh my God, well, what is that? And so people have, we have this excitement in the market, everything's going up, everyone's excited, and then 40K put. So let's go back a little bit, and we can use it for speculation or hedging. So that means if we're speculating and we're on the board, we say, hey, listen, we've had this high. I think it might be going way low, below 40K by the end of June is my bet. Or as a hedger, maybe I own spot and I want to protect from the possibility of a loss below 40K. I'll accept a little bit of back and forth movement, but if it goes below 40K, I need to be able to, kind of gain what I'm going to be losing with my options contract.
Yeah. So if I was to distill what you just said, just for our audience, right? So if you think about what the market's comprised of, and that's kind of what you're showing here, the market's comprised of, you got asset managers that are managing funds and Bitcoin positions. and they're looking at the end of the quarter and trying to figure out where they're going to end up to be able to report on. You got actually businesses running, right? So you got miners, you got any other type of business that's running and utilizing Bitcoin, holding a Bitcoin position in some sort of manner that needs to be able to manage their risk in some sort of way. So they're looking at the market as a whole and saying, wow, how do I protect myself, in order to be able to manage any downside risk? That's what you're seeing on that put maybe. And then you also have the speculators that are just out there saying, okay, where can I profit the most in the short term here, and where, with the possibility of the market can go.
Yeah, I think that's a great way to put it. Yeah.
Okay. Perfect.
and we're seeing this one trade that's sticking out. I mean, the open interest on this is the highest open interest for this call is about 100. I think it was like 136K, but the put was 136 million. And then, the open interest for the put is at 256. It's nearly double. So twice as many people, or, somebody with twice as much money is taking a position that they want to protect any downside losses, and think this could be Coinbase, this could be plenty of these people who are buying and selling assets who have a lot of money on the line, and, saving a cent goes a long way. They're trying to save a lot of cents here,
100%. And so your analysis here, this is what you guys share with your clients, and you would have shared this with your clients. If I was your client, I would have received this and I would have been like able to identify this with you, basically, based on the data set.
Yeah. So we send this a full report. We'll show an example of it at the end of the just what the report looks like. And we've been, I'll go in every day and I start kind of just picking through things in the spot market, in the options, in the futures market stuff that just looks funny. What is that? If you can even just ask the question, maybe it's nothing, but a lot of times you can find a little bit of, understanding from it. So, this 40K, and we'll see, as I'm going to go it's a few more data points as we go further. And you'll start to see it's getting further and further. The 40K, so in the spot market on May 5th, it's kind of moving forward a little in time. There's this little dip back to the same price. Remember, they've got that 100K call with about 150 million, the 40K put. We're still thinking of that, and I'm seeing it every day. I'm seeing what this is. That 140K put. And we're still going through time. We're all thinking, hey, there's a huge risk here. People protecting, people placing positions. We get to May 10th. So, we've really saw this on the 30th of March. It's now the 10th. That position is still holding strong. We've actually seen a little bit of the calls come off the board. So even the calls are lowering. So people are getting maybe a little more nervous. They're saying, the market's we saw that high. I don't know if it's going to go to 80. I don't know if it's going to go to 100. So we're still watching that 40K put. We'll move forward. We still see this. We see the 40K. We still, it's all there. It's still going. And then we got bam, May 14th. It's been, 15 days. We see a multi-day drop from, it went down to, it was at 58-ish, and we went down to 55K, down to 36,662 down here. This was where the data point that we took was. It's a multi-week drop. It's 35. I think it got to a little bit more than 35% in about 8 days, which having that protection of a 35% drop in your portfolio, if you have a portfolio, if you're thinking about it that way, that's awesome. If you're a speculator and you took that 40K and it's down to 36, you're in the money. You're not protecting, but you're not protecting from the loss, but you're gaining on the loss of the market. And we see this increasing sell volume into it. So there's like a lot of people, a lot of power selling into the market.
So you basically were able to identify through this data 15 days ahead of time a data point that started to tell a story, is kind of how.
Yes. And in our report, we saw a few other data points. For the simplicity of this report, or for this presentation, I want to just, spot market and options market. But there was a few other things that we saw in there that, spoke to us a little bit. There was some blockchain data about the hash rate where, you could see a little bit, a little worry in it where, if I can't make money mining, I have to turn it off. I mean, I can't say that, and you'll see that in the market. I'll bring that chart up after this, and I can kind of show where, as this drop happened, hash rate was cut, and it follows this almost a similar chart. And it's miners turning off, the hash rate, the difficulty level dropped in the mining algorithm. We saw there's some swaps that, swaps kind of dipped. And there's multiple things. This is just one that was, we kept, even it was just one presentation, and every trader we talked to went, ooh, what else are you seeing? And there was a few other things that we could kind of point to.
Yeah. So if I was to distill the story up just a little bit, because that's some great information there. Because as traders, you're always looking for correlation, right? So you get this one data point that's glaring, right? This is not like just an average data point. It was more than double the volume on the put side, right? Yes. And effectively, you're saying, okay, each day you're seeing a little bit of change continue to take place. So less calls each day, telling you more about the story.
Yes, coming off the OIs, coming off the
story. And then all of a sudden you're starting to see correlation with other data points you guys look at, which starts to really give some emphasis that there's something happening here. And
one data point isn't much, but if you start seeing through 2, 3, 4, you're like, I don't know. There's a lot of worry here, especially after an all-time high of excitement, and elation. Yeah. And it goes in the total opposite. Yeah.
Yeah, everybody's in the absolute greed phase, and Bitcoin's going to hit 100K before June, and yep.
Yeah, well, it's funny. And then after, I would love to keep going, but I'm trying to keep it tight. We start seeing these 200K calls, and right now, I was looking at today's, we've got a 400K call in the market, and you're like, okay, that would be amazing. That'd be great if you're a long buyer, but there's a lot. That's a big movement. That's we're at, what are we at, 55 plus right now. We're going to 8X or whatever in the next, by December was where that contract was placed. And you're thinking by December, with somebody's thinking by December that there's going to be a 400K call, and they're going to be so in the money, I doubt it, but a man can dream, right?
It's interesting that story can be told through options, and I think that's kind of like what you're trying to share with us here today, is that there are some insights to be seen about how people are thinking about the market, the spot market, by using these options.
Yes. Yeah. And so, so what happened is kind of, I'm going to wrap it up a little bit. We had this 100K call over here, the 40K put that we were watching, and now we've got the spot price in blue over here that is now it's below that 40K. People are in the money, and there's actually a handful. We've got an 80. It almost looks like an 80K, maybe a 75K put in the super in the money. We've got these 50Ks right here. The 52 and the 50K, which were the second and third highest open interest, and a lot of calls at this 160K, 120K, 100K are really out of the money, and we see, so we see this, and what kind of happens less is buyers of puts are really happy. They have protected, or if they have, hedged their portfolio from downside risk, or if you're a speculator, you took the directional trade and you came out on top. If you're a call buyer, maybe not so much. You were taking a risk, and it didn't. Went backwards, and it didn't pay off. And now we're I'm just going to go forward 2 weeks just to kind of wrap up this little case study that we've got here. Is we had the high and the low, and we were kind of looking at this little area here, and then, this slow trickle down. The volatility isn't there. That was in the big move, but we're still having the back and forth where it's, there's some volatility in the market. So this is the same contract. Looks totally different now. It's been 2 weeks out, and we're in May 30th now, at the end of the May contract. This open interest on the June contract looks totally different now. Halfway through the month, we had this huge drop. The 40K put is still there, But we in the call contract we see this 50K and the 52 and the 48K come in. The whole market is shifted downwards. For the calls and the puts. The puts have shifted lower. The calls have shifted lower. And there maybe isn't. The highest call is still at 160K. I mean, but I don't know if it particularly. It's not good. It's not going there soon. We've got that 100K, but this 50K kind of starts rising up the board. So you see this gap between the 50K and now the 40K. It's really tightened over time. And that's kind of, you kind of get to see the story of what traders are placing their trades.
So all of a sudden traders decided like, hey, maybe 80K is out of the question. We need
maybe
to start
100 is, Let me 50 sounds a little better.
Fear starts to come into the market, and you can see the prices. They were at that time, they were trading at what was that, 40?
I think that was where my cursor was, but
the cursor? Okay.
I think we went from 36 and we went almost down to, this is where we were down in like the 28K, 30K. We were kind of bouncing around a little bit, which is, it was still below the 40K, so people are still hoping to maybe a bigger dive deeper down to 20K or something like that. But, even these, we've got the 36, if you can look down here in the bottom right corner, the 36 came on the board, the 28 came on the board puts. With the second and third open interest. So people have shifted their puts lower, thinking by the end of June, I think it's going to keep running low. And, it tells the story of where everyone's placing their trades. So, and I've got a little wrap up of kind of what, maybe some stuff to go look into after this presentation for educational purposes. Teach yourself a little bit. It's time takes time, but we kind of want to know your enemy, know who you are buying and selling to and from. That's where we get those market participants, the CFTC, commitment of traders. Go look at what each one of those people, institutions, whoever, and how you fit into that. I like to think of who's the market maker, who's the person that's on the other side of this trade, and how are they thinking. We want Exxablock's customers to learn to view the market as a whole, with the spots, the options, the futures, the swaps, and the blockchain data in there, because we get a little extra with cryptocurrency. If it's a company, you get to look at the spreadsheets and see where they're getting their money from. For cryptocurrency, we get to look at the blockchain data and see how many transactions are occurring, and are people, where are they shifting it, or why are they shifting it? Who knows, but we can infer some things from it. And we really believe that knowing how market participants use their derivatives in their trading, it can really present a picture of what is happening in other markets. And we were able to see this drop coming from up to 15 days earlier, and we probably could have seen it a little bit earlier. We were looking at the highest OI, and we were kind of shifting back and forth, maybe looking 2 out. But when we saw that 40K come up, it was, you couldn't turn away. It was so glaring. So finally, this is kind of what the report looks like. All this data is collected under Exxablock. It's blockchain data. We've got spot market, option markets, future markets. And then on our second page, we kind of have the volatility indices, some cool stuff over here where you see the highest open interests. And we started building in like kind of a bookcase where, it's the highest OI call and put, and it almost builds a barrier on either end of where the spot market tends to go. Some profit and losses of the highest open interest contracts. And there's a lot of data here, so it can be a little hard to understand, but if you can go one at a time, we try, and part of this is an education for everyone. And you're not going to learn it in a day, but day after day, you learn a little bit more, and we have it all aggregated. and it's some great stuff. So thank you so much. I'd love to do some questions and open it up. This is our website, exxoblock.com, Twitter, Discord. You can, go ask some questions. We'll see some of the data stuff that we post out there and, learn a little bit more.
Absolutely. This has been excellent information. I think we do have one question to start with. It says, does option strike pinning happen in crypto space as well?
What do you mean? What do you think we mean by that? Like pinning or?
I'm not really sure. Option strike pricing, maybe?
Pricing, perhaps?
Yeah.
Yeah, I mean, yes. So you always have to kind of price an option contract, and it's based off the premium has to be priced somehow. I don't know if that answers the question, but you have to, somebody is going to say, hey, if you want this insurance, you have to pay this certain premium to get that insurance, and are you willing to? I don't know if that answers the question.
Yeah, and I think if we think about it as just overall, right? I mean, if you go across all the markets, right, using options it's the same fundamental way to use them across each market, right? There's really, I think maybe that's part of the question too. Is there a change in how options are priced and used, in the crypto space versus other markets?
Yeah. So technically, no. I mean, they're used for the same way. Pricing an option contract, there's very different, it gets very deep with the Black-Scholes. People have different ways they believe that they can price a option contract. But that's a deep question. It's something that's been talked about for thousands of years, and everyone always talks about like, how did they price the tulips and how did they price right. I mean, derivatives used to be very frowned upon because it was you're going to take a negative. You think that our government is going to go down? That's like the history. Right. It was illegal. Derivatives where you were able to bet on an asset going down was very frowned upon and made illegal. So they're actually a fairly recent thing. They've been around for a long time illegally, but to have them so publicly available is a fairly new phenomenon in most markets.
Okay, we'll go on to the next question. So it says, is the open interest data for total of puts and calls publicly available? And if so, how will we access it? I think yes. I think we did make it available.
Yeah, so it is publicly available. We aggregate it, so that's kind of part of it. Is there a lot of we sift through data. So this is Sunwoo's expertise, is pulling in a lot of data, sifting through it, and making sure it's you can actually get something out of it, because time and sales is public on most exchanges, and if you go to the CME, you can scroll through time and sales and right. See, if you want to look through a never-ending spreadsheet of X bought Y at X time or Z time or whatever. Yes.
Okay, so I guess with that said, you guys had mentioned earlier. You actually mentioned earlier in the presentation about this. I think where are you pulling all that data together from? You said, I think, a Deribit. What were all the?
Yeah, let's see. So we've got Deribit, Ledger X. Let's see. Yeah, this one is we've got Deribit, Ledger X, CME, and OKX. Yeah, big.com. Yeah. So for the options, those are kind of the options contracts that they have the highest open interest, and there are some other options contracts out there, but they're not particularly, it's like almost irrelevant when the time comes that they actually have enough volume on them, or open interest. It will definitely be something we'd love to add into the report.
Fantastic. I got a question. So can you talk a little bit more about the on-chain data that you guys provide?
Yeah, let's see. So I pulled up today's report so we can actually go through some stuff.
That would be great if we could have an example.
Let's see. where's the share? What screen can you see? Hold on. Let me reshare. Okay. Do you see, this is the daily report?
Okay. Yep. Got it. Perfect.
Yeah. Okay. So this is our daily Bitcoin report. It sends out in a PDF every day.
Okay.
This was October 9th. So this was, it's aggregated all of yesterday's, and we send it out first thing in the morning to your inbox. Let's see what we've got. Okay. So we've got market overview. This is the blockchain network. So, we've got total fees over 30 minutes over yesterday, total fees for the year. This 2000 or what is that? 2021, 411. That was actually, I believe that was during the all-time highs. We see this huge uptick in total. Yeah.
Yeah. So hold on real quick. If you don't mind, I'm going to ask some questions on this, if you don't mind. So you said it says 30-minute mean total fees. Can you explain that?
This is where Sunwoo comes in. Sunwoo, are you there?
Okay. Yeah. If you don't mind.
Basically, because it says Bitcoin. Basically, Bitcoin is a new block. So roughly speaking, it's created every 10 minutes. So in terms of statistical the measure aspect, you are thinking that maybe 10 minutes is too short to get some meaningful output. So based on the research, you decide to 30 minutes the time resolution. It seems great in terms of get into meaningful, let's say, statistical the measure. That's why we compute the multiple time resolution, even in the case the block tick by tick kind of concept. That means every the block created, also the 10 minutes, 30 minutes, 1 hour, even the 6 hour. But among them, we put here, let's say 30 minute kind of a bar based on kind of a statistics, because it seems more the naturally fit into the trading. So that's why we provide all the results based on data. Also, we have built many other different analytics, but because of the space constraint on the report, we provide the most important value, like let's say the fees and also how much the miner, for example, make. This is a kind of a proxy about how the market, let's say, works. The other thing, maybe next page, we also provide the hash rate, how the market hash rates change over the time. So that kind of stuff. But we have many other analytics, but we are always try to add more depending on the user's demand.
Yeah. So remember I was telling you about the total hash rate dip?
Right.
That we were talking about in the middle of this. So that's what this is right here. The price there was a big sell-off. I think this was the actual rate when we were looking at it. This is actually after it, over those couple of weeks where it took a real dip, to, what is that, 6/11/21, where, over the next 2 months to the end of June, there was this trickle down sell off, and it became less, it was less valuable for miners to actually be mining. So people have to turn off, they have to turn off their, especially if they're, a miner could be using a futures or an options contract to protect themselves from this and just keep running and protecting the network. But
I'd like to add one more thing. Jack, would you go to the previous page?
Yes.
Yep.
So even you are trading the spot or on the derivative, I think it's good to see this kind of blockchain report here. The reason is, let's say, when the major market event happen. For example, one of the good examples is, let's say, the news you may already heard. Chinese government banned all the cryptocurrency. That's all illegal. That means somehow there's all the activity happen in the crypto world, right? But indirectly, eventually, it get into the blockchain level. As a result, for example, let's say everybody try to do something in the blockchain. As a result, the fee is going skyrocketing. So even we start looking at any crypto data, the spot or derivative data, if you tracking only, for example, in this case, of course, we track the many different measures, but one, for example, in this case, even you are only tracking this fee, let's say you already see, something happened on the day, so major market event happening. So based on that one, you can get the more decision, the criteria, how to respond or how to revise your strategy, your trading strategy.
Got it. So in how I'm interpreting this, and I'll respond back a little bit. So, and I'm just going to break it down in simple terms for my own simple mind, I guess. With the thought process for people to how to kind of think about this is that on the blockchain network, and for Bitcoin specifically, right? We're talking about what we're looking at here is that every 10 minutes, a new Bitcoin block is created. And inside that Bitcoin block, the miners are receiving rewards. So you're basically showing the cost or the fee structure that's associated with those rewards, right? So you have a reward and you have a fee associated with it, because every time you do a Bitcoin transaction, there is a fee that takes place. And part of those fees are what is distributed out to the miners that are securing the network. And what you're showing here is over a 30-minute time period to basically smooth it out some, right? To be able to provide a better view, because it's be probably too volatile within every 10 minutes. And then this allows for the kind of the average to be seen a little bit more clearly, I guess. Is that
also too noisy. I mean, if you look at the original, the low resolution, for example, 10 minutes or less, you can see something like a random noise.
Okay.
So it's kind of as you say exactly. If you let's say get a little bit the longer time period, it's kind of a smoothing effect. But if you take a much longer, let's say for example 1 day or the 6 hour, it's too much smoothing. So you are losing so much information. The criteria is what's the optimal in that case the number in terms of a little bit smoothing, but still keep the meaningful information. So that's why we did some kind of simulation, some kind of research. To eventually end up 30-minute kind of, let's say, the resolution seems kind of the best, the option in terms of, let's say, the analytics perspective. Of course, it's related to trading, but in the near trading, you may use the multiple result. For example, one thing is that the 1 minute, for example, let's say 10-minute kind of, let's say, this fee, the time series. The other one is 30-minute. Maybe the third one is maybe 1 hour. By using for example, the 3 different time series, by providing some weight for individual one, you can get the robust, let's say both the short-term, long-term intraday, the integrate kind of a signal generation, something like that is more the preferable in the near trading.
Yeah, that's absolutely fascinating. How to think about that to generate, like you said, to generate a signal for yourself. And I think just I'm gonna break it down a little bit more for people to understand a little bit on why this data is so important and how you guys are kind of thinking about it. And you guys can probably correct me if I'm wrong on how my thinking is, but with the blockchain data, and when we're talking about fees, and I think Jack, you mentioned this earlier, why this is important is because you're able to identify what these market participants as the miners are doing, right? And if we're seeing fees spike or fees drop, it's probably something that's happening on the mining network, considering that you're measuring hash rate, right? You're measuring fees. So you're actually seeing things change and take place based off of what miners are actually doing. So if hash rate's being measured and hash rate drops, what that actually means is that miners are turning off their machines that are securing the network. And they're probably trying to manage their cost structure based on price activity that's taking place. So therefore, you're seeing this data point change. So you're actually getting to see the participants and how they're operating their business. Yeah. Right, and that's
and a miner has to pay for electricity. So right. I mean, if you could pay for electricity with Bitcoin, that would be great. But I don't think I've heard it come up a few places, but generally right. You have to pay with USD or wherever you are.
Exactly.
China, you have to pay with. And like you can see, which is this chart is called the network difficulty levels, because we see the hash rate go down, but we see the network difficulty levels adjust, for the mining, and it's an automatic system. So as the market goes down, the participants come out, the miners come out, the difficulty levels come out because there's less miners. I mean, it's pretty cool to watch it actually happen in real time.
Can you go back a slide? I think there's the question.
Is it this slide that
I think the first slide, yeah.
Or up here?
No. I think it's the blockchain network slide. Yeah.
This one?
They'll show the whole slide. Yeah. Oh, number one. They're asking for number one. Yep. Okay. So this is back to the options data, right?
This is market overview. So, this is where we see we've got our CFTC commitment of traders down here, daily transaction volumes, and then, exchange traded volumes. I like this chart a lot because we get to see, we talked about options, which have almost the lowest, the lowest nominal value, I guess, would be the right way to say it, of all of the other of the spot markets, future market, and swap, which, look at the swap chart compared to all the other ones where there's a, how much volume is transacting. This is the reason why swaps is because swaps are open 24/7. I would say, at least. I think Sunwoo might have a little.
Yeah, there is some little bit historic about why the swap is so big in the cryptocurrency, because originally spot came up as a first tradable space in the crypto world, but after a few years after, let's say, the BitMEX, the kind of they have a great idea about the perpetual swap. Perpetual swap is basically the futures without the expiration. So it hit the market is the very good let's say the impression. So they as an institutional, let's say, the trader point of view, they don't need to buy the Bitcoin, right? It's a derivative product. Also, there is no expiration, so they don't need to worry about, let's say, for example, let's say the rolling stock or other thing. So, but the problem is, without the expiration, there could be the problem is possibly the price difference between the derivative price and the underlying spot. But the good idea is every, for example, fixed hour, daily, for example, 8 hours, for example, 6 hours, something like that, they kind of adjust the difference. Depending on the gap, the buyer pays some money to the seller or the vice versa through the premium rate, funding rate. So as a result, this market is become extremely popular. That's why still, even today, the perpetual swap market is very big compared to other guys. But nowadays, it's a little bit trendy. Trendy one is now getting into the DEX. This exchange kind of the stock is now getting popular. But still, in the Bitcoin point of view, it's a kind of away from that kind of DEX stock. That's why still the perpetual swap is a higher volume than other asset class. That's my view.
That's very interesting. I do like how you guys put together all that kind of snapshot data on that first page.
Well, and another thing.
Also, one more thing.
Yeah.
I'm one more thing. Would you the second page of a derivative, blockchain network?
Yeah.
So okay, second page. Next page.
Yeah.
Also, we put some kind of correlation between the asset class, even the financial market, because So basically, let's say when even you are trading in the crypto, sometimes you need to know how the market moves in the other market, such as the US equity market, US futures, US option. Also, how much they impact each other. So that's why the correlation between the multiple market even the cross market is very important. The interesting, we found out there is some kind of a cycling effect or the seasonal effect between the multiple markets. Sometimes they are very strongly correlate. Sometimes it's not. So that's why it's good to trace that kind of correlation. As a result, sometimes you conclude that, the cryptocurrency market is heavily now impacted by US equity market. But after a few months after, it's nothing. There's no relationship at all. But after another 3 months after, they are now catch up together, something like that. There's a very funny kind of the temporal kind of, let's say, chain between the correlation aspect. So as a result, by tracking, let's say such correlation, I cannot say which one is the kind of, let's say indicator to each other, but by tracking that kind of relationship, you can improve your quality of your signal to your trading.
Yeah,
there is a legal lag effect somehow, but you cannot guarantee which is lead, which one is lag.
Yeah, that's a great point, Sunwoo. Thank you for pointing that out. And for me, I've been excited to watching actually just recently the decoupling, right, of the crypto, Bitcoin market from the traditional market by the breakout that we're seeing take place right now. It's been stunning to watch, and all this data is just fascinating to see how it's kind of shares and shows that picture, along with the seasonality, like you said, and how they start to correlate again and then decouple. Exciting stuff. Listen, we are 1 minute. I think we're 1 minute on the hour here. I want to first say thank you guys. This has been incredible. I could talk with you all day long about this stuff. I want to go and see you and hang out so we can dive deeper. Yeah, thanks again for sharing this. It's been a great session, and we'll have to do it again sometime.
Thanks so much. Have a great one, everyone.
Thank you very much.
Enjoy your time.
Bye-bye.
Thank you so much. I want to give a big thank you to all three of those guys, Anthony, Jack, Sunwoo. Thank you so much for your time today and for that great session. Thanks, guys.
Thank you.